CRA announced their 2026 tax rules and guidelines, and I'm here to simplify it for you. Hello everybody, welcome to Wiseconomy. I'm Jashandeep and I'm glad that you're here watching this video. And here's what we do on this channel. We break down all the confusing money and finance stuff that Canada throws at us and we make it simple. We are building a community of Canadians who want to take wise decisions to make their lives better. Whether it's taxes, saving money, investing, or just understanding your paycheck, we are here to help you figure it out. If this is your first time here, I want to personally invite you to subscribe and become a part of our community. We are all in this all together, and every single person in this community is working towards a better financial future. Now, let's get started. I remember when I first started working, I had no idea how different tax deductions work. I would get my paycheck and see all these deductions and I would think where my money is going. It was so frustrating. And I know taxes can feel really scary and confusing. Like you hear the word tax and your brain just shuts down. But here's the good news that changed everything for me. Some things are actually getting better for your wallet in 2026 with all these new guidelines. And I'm going to break it down for you in a way that makes total sense. So grab a coffee, get comfortable, and let's talk about what's changing with your taxes here in 2026. This stuff that actually matters, which is going to help you understand where your money is really going. And by the end of this video, you're going to feel much more confident about your finances. Let me start with something that's actually pretty cool and genuinely good for you. Canada is lowering its lowest tax rate from 15% to 14%. Now I know 1% might not sound like much when you're hearing it, but think about it this way. That's your money staying in your pocket instead of going to the government or the CRA. Here's what this means in real terms. The first $58,523 you will earn will be taxed at 14% only instead of 15%. So if you make that amount or less, you're paying less tax on every single dollar you work for. And if you make more, then that's a good news too. You still get this lower rate on the first chunk of money that you earn. The higher percentage only kicks in after you hit $58,523. Here's the quick example to better understand. Let's say you earn $40,000 a year. Under the 2025 rules, you are paying 15% federal tax on that. Now in 2026, you are going to pay 14%. That might be a difference of a couple $100 a year. And when money is tight, a couple $100 is real money. The best part, if you earn less than about $16,000, you might not owe any federal tax at all. Isn't that nice? That's the government saying we recognize that you need every penny to live. Feels good. So let me explain the new tax brackets for 2026 in a way that actually makes sense. Forget all the complicated terminology. Think of it like climbing stairs in a building. Imagine you're walking up a staircase and each stair represents a different salary level. When you step on a stair, that stair has a price tag, which is a tax rate. First stair, if you make up to $58,523, you pay 14% on that money. Second stair, if you make between $58,523 and $117,045, the extra money you made above $58,000 gets taxed at 20.5%. Not all your money, just that extra part. Now, third stair, between $117,000 to about $181,000, that next chunk of money, that gets taxed at 26%. The fourth stair, from $181,000 to $258,000, that jumps to 29%. And if you make more than $258,000, the top rate is 33%. Now, here's the super important thing to remember, and this is where people really get confused. You don't pay all these rates on all of your salary or your money. You only pay the higher rate on the money in that specific stair. Let me give you a real example. Let's say you make $100,000 a year. You don't pay 20.5% on all of that $100,000. Here's how it actually works. You pay 14% on the first $58,000, then you pay 20.5% on the remaining $41,000, which is $100,000 minus $58,523. That's it. You don't jump to the top rate. It's not like you make $180,000 and suddenly the government takes 26% of everything. That's not how it all works. And understanding this can actually make you feel less stressed about earning more money. Now, there is something called the basic personal amount. I know it sounds like boring government stuff with a fancy name, right? But it's actually really simple and really helpful. Basically, the government is saying, we are going to let you earn a certain amount of money before you have to pay any federal tax at all. It's like a little gift. That amount for 2026 is $16,452. So if your income is $16,452 or less, you owe zero federal tax. Nothing, nada. You don't have to pay anything. Your income is completely tax-free up to that point. This amount goes up a little bit each year because of inflation. And as the cost of living increases, the government increases this amount too. So it's actually getting more generous over time, and more people are getting to keep their lower income without paying any taxes, which is kind of amazing when you think about it. Think about it this way, that if you are a student working part-time, or if you are just starting your first job, or if you're doing any gig work on the side, this basic personal amount is protecting you. The government is saying you're allowed to earn this much without giving us anything, and that's pretty cool. Now, if you make more money, this is important to understand. The good news gets a little bit smaller when you get to the higher income levels. If you make more than $181,000, the basic personal amount starts to shrink. This is called the reduction threshold, because for every dollar you earn above $181,000, you lose a tiny bit of that basic personal amount protection. By the time you hit $258,000, your basic personal amount is down to $14,829 instead of $16,452. You're losing some of that tax-free protection, but here's the thing. Even then, you're still getting a break. It's not just quite as big of a break as someone making less money. And honestly, it's the government's way of saying, if you're making really good money, you can probably contribute a bit more. Now, let me be real with you. These changes help regular Canadian workers the most. If you're working a normal job, living your life, trying to make ends meet, you're getting a genuine break here. Lower income and middle income earners feel this change more because you're keeping more of your money every single paycheck. The tax cuts happen on the money you actually depend on every day to pay your rent, to buy your groceries, and handle your bills. So, if you're making $35,000 a year, and this feels like a real difference in your life, if you're making $50,000 a year, this is actually important because it means you have a little more breathing room in your budget. Maybe that extra money goes towards saving. Maybe it helps you pay off that debt. Maybe it means that you can buy the Christmas presents. You can buy the Christmas presents without stressing so much, and that matters. Now, I want to be totally honest with you because I care about you getting accurate information. These are the federal taxes only. Your province or territory also takes its own taxes. So your actual tax bill will be higher than just these federal numbers. You absolutely need to look at your province's tax rates too, because they're different everywhere. For example, if you live in Ontario, you're paying the Ontario Provincial on top of this federal tax. If you live in British Columbia, you're paying the BC tax. Every province is different. So don't just look at this federal rate and think that's your whole tax bill. Also, these numbers are about income tax, the tax on the money that you earn. But there are other taxes too, like the CPP contributions, which is the money that you put away for retirement, and the employment insurance, the EI, which is the employment insurance. There is also GST when you buy things. So your total tax burden is actually more than just the income tax rate I'm telling you about. And one more thing, that's really important. If you're self-employed, you need to be doing tax planning. If you have investments that are making money, you need to think about your capital gains tax too. If you own a home, it goes up in value, that might matter as well. These changes are a good foundation, but your personal situation might be way more complicated than what I'm explaining here. There are some other 2026 changes that might affect you directly. So let me quickly cover these. If you have kids, the Canada Child Benefit is going up a little bit. That's money that goes directly into your account every month to help with the cost of raising children. It's not huge, but it helps. If you're saving for retirement, your RRSP limit is increasing to $33,810. That's a registered retirement savings plan. And basically, it means you can put more money away for your future before you have to pay taxes on it. And that's really a good thing because it lets you save more for when you're older. If you're getting old age security, that's money the government gives you when you retire. The income threshold is changing for that as well. Basically, you have to earn a bit more before they start taking that money back. So if you are retired or planning to retire, this is good news. These all add up to show that government is trying to help people keep a bit more money in their pockets across the board. Now, before I wrap up, let me tell you about mistakes I see people make all the time when they hear about tax changes. Number one, people think this is free money. It is not. It's just that you're keeping a little bit more of the money you already earned. Don't spend more just because taxes are slightly lower. Number two, people ignore their province's taxes. This federal cut is great, but your province might not be cutting taxes. You need to look at the whole picture. Mistake number three, people wait until tax time to think about taxes. If you want to maximize these benefits, you should think about it during the whole year. Talk to an accountant if you can. Don't just wait and be surprised in April. Mistake number four, self-employed people and people with investment income don't plan ahead. If this applies to you, seriously consider talking to a tax professional now, not in March or April next year when you're panicking. So, here's the real bottom line. 2026 is bringing some pretty decent tax breaks for most Canadian workers. It's not going to make you rich. It's not going to change your life completely, but it should mean a little more money in your paycheck or a little less that you owe at the tax time. The fact that you watched this whole video shows that you care about understanding your money, and that makes me really proud. So many people just ignore this stuff, but you are here, you are learning, and that's going to help you in life. If this video helped you understand taxes better, please give it a thumbs up. Seriously, it helps me so much. And if you have specific questions about your taxes, because everyone's situation is different, talk to an accountant or tax professional who knows your full situation. If you need any recommendations, please feel free to reach out to us and we'll be more than happy to recommend you to somebody. Thank you so much for watching, and I will see you in the next one. Take care.